Dividend investing is my favorite way to create wealth and generate income from the stock market. In this video, we'll cover some dividend investing basics, and I'll show you a big mistake that investors make that totally ruins their investment returns. Seriously, it's like the number one, top, most common, biggest dividend investing mistake you can make, and people make it all the time. What's up, everybody? Welcome back to the channel. I'm glad to have you back here with me. If it's your first time here, my name is Jay, and on this channel, I give you the tools, the tips, and the tactics that you need to get the most out of your money. Today's video is all about dividend investing. More specifically, the biggest mistake that I see dividend investors make. It's the most common mistake, especially among beginners, but no one is immune. But before we can get into that, we need to know a few basic bits of information. First, what is a dividend? Simply put, a dividend is a portion of a company's earnings that they'll distribute to shareholders, most often in the form of cold hard cash. Dividends are great because we can use them in two ways. First, we can take the cash, and it's a great way to collect some income off our stock investments without ever having to sell any of our shares. Secondly, we can enroll in what's called a DRIP program, or Dividend Reinvestment Program, and when we're paid dividends by the stocks we hold, they get reinvested directly back into more shares. So because our dividends get paid out and then reinvested back into more shares, that means we own more of the stock than we did the prior quarter, so the following quarter we get paid more of a dividend, which then gets rolled back into more shares, and that, combined with hopefully the company increasing the amount of the dividend over time, creates a snowball effect which can really accelerate our returns. The second important term we need to know is dividend yield. Dividend yield is the amount of the dividend a company pays divided by its current share price. So it's most often expressed as a percentage. And that brings us to the biggest mistake I see dividend investors making, is focusing too much on dividend yield and chasing a high dividend yield. So why is chasing a high dividend yield a mistake? Chasing a high dividend yield is a mistake because too often people get blinded by the potential high returns from the dividend and they ignore all the other factors that might be affecting a stock. So if you see a company that has a dividend yield of something like 10%, it's easy to think, oh, I can invest $1,000 and I can get a 10% return on my investment just out of this dividend. And while that may be true on the surface, as always, the devil lies in the details. You see, all too often, a high dividend yield is often a sign of a company in trouble. Like we mentioned a little bit before, dividend yield is the amount of the dividend divided by the share price. So if the yield is very high, that often means the share price is low. And when a share price is low, it's often for a reason. Now, it's possible the company just had some recent bad news that's not going to affect it long term or something like that temporarily dropped the stock price down. But more often, it's an indicator of a company that's facing some long-term struggles. And the reason you see this a lot, for better or worse, all too often, cutting a dividend is one of the very last steps a company will make to try to preserve cash and capital. So a company could be going through layoffs and cutting back on capital expenditures and cost cutting all around the company. And then when they have nowhere else to turn, they slash that dividend out from under you. Now we can see an example of how chasing a high dividend yield would be a big mistake in action if we look in my portfolio. A stock I've owned for years is BP. Now, I bought BP right after the stock got destroyed after they had that giant oil spill in the Gulf of Mexico a few years back. I, being a bit of a naive investor at the time, figured, oh, this is just a temporary setback and the stock price will rebound in no time. Well, here we are 10 years later and the stock price really hasn't budged from where I bought it at back in 2011, I think it was. But over those 10 years or so, BP has paid an amazing dividend. I think for the majority of the time I've held the stock, they've yielded somewhere between 5 and 7%. So even though the stock price wasn't moving, it was worth me to hang on the stock because they were returning that 5% to 7% in dividends. Now recently, BP's share price has dropped due to all the turmoil in the oil industry, and that increased their dividend yield up to about 11%. So if you were a new investor just starting to look at BP's stock, you might see an 11% dividend yield and start getting all excited about those huge dividend payments you're going to be getting every quarter. But instead, what happened? BP realized that paying out an 11% dividend is not sustainable in the current state of their company, so they slashed it. Their dividend went from 10.5 cents a share, cut in half down to 5.25 cents per share. So if you're a dividend investor, relying on the income from the BP's dividend, not only did your quarterly paychecks get cut in half, but you also have a floundering company whose share price will at best be going nowhere, but most likely also be declining in value. So not only are you losing in dividends, you're probably losing your capital as well due to the declining share price. Another recent example of this is with Wells Fargo. Now, Wells Fargo is a very popular bank. They've been around for hundreds of years. And if you were looking at investing in Wells Fargo stock recently, you may have seen an 8.5% dividend yield. Wow, I can invest in Wells Fargo, this 200-year-old bank, and get an 8.5% dividend? And just like we saw with BP, that high dividend yield for Wells Fargo was a sign of trouble to come. Where we saw BP cut their dividend by 50%, Wells Fargo went even further. They cut their dividend payment from 51 cents per share all the way down to 10 cents per share. So if you're holding Wells Fargo stock, your dividend payments just took a huge cut. And because they're a sign of a struggling company, you're also once again probably losing your capital due to a declining stock price. So what should you, a smart dividend investor, look for instead of just a high dividend yield? I'll tell you. You should look for the like button down at the bottom of this video, click it so it turns blue, because it pays dividends for me within the YouTube algorithm. But seriously, if you're doing some research into dividend stocks and you want to know where to look beyond just the dividend yield, here are a few factors to consider. Now, the first factor you want to look at when considering a dividend stock for purchase is dividend history. If a company has a long and stable history of paying and increasing their dividends, that's likely to continue in the future. Now, a great place to start your research on any dividend stock is with the Dividend Aristocrats list. And what the Dividend Aristocrats list is it's a list of every stock in the S&P 500 that has paid and increased their dividend every year for 25 consecutive years or more. This means not only are these companies committed to paying a dividend, but they're committed to raising the amount of the dividend they pay you every year. And if you want to narrow that list down a little more, you can look at the Dividend Kings list. Dividend Kings are companies that have raised their dividends for 50 or more consecutive years. These are your big, solid dividend companies like Johnson & Johnson and 3M. They're big, solid, stable companies that are also very committed to paying dividends to their investors. Secondly, we want to look at the trend of company performance. We want to look for companies that are increasing their revenue from quarter to quarter or year to year. If a company's revenue is declining, that's eventually going to affect their dividend and their ability to pay that dividend to you. But if a company's revenue is increasing, that likely signals good things for their dividend and their ability to continue paying it. The third thing you might want to consider when trying to research a dividend stock is their debt ratio. You want to make sure a company doesn't have a ton of debt on their books, because as that debt comes to maturity and they're liable to pay down that debt, that could affect their ability to pay their dividend. You see, if they have to divert all their cash from paying dividend to paying debt, that could signal a potential cut coming in the future to their dividend. And possibly most importantly, you want to look at the dividends as a percentage of the free cash flow. This will show you how comfortably a company can continue to pay their dividend out of their cash that's not allocated toward any other part of their business. The lower the percentage the dividend is of the free cash flow, the safer that dividend is to continue, and possibly the more likely it is to be raised in the coming quarters. We're looking at all these factors to determine the safety of the company's current dividend and the probability of the dividend being raised in the future. As dividend investors, that's what we want. At a minimum, we want our current dividends to remain. But ideally, we would like the dividend payments we receive to increase over time. Now, I'll have a video coming soon where I dive into the nitty-gritty of all this and really show you how to research a stock and how to look at all these factors and where to find all this information. So if that's something you want to learn how to do, be sure to subscribe to the channel so you don't miss it when it posts. And again, if you got value out of this video, please hit that like button down below. It's a big signal to YouTube that they should show this video to other people. It really helps out the channel. You can also follow me on Instagram. My handle is somewhere around here. I don't know where I'm going to put it yet, but follow me on Instagram. I post there almost daily, giving my more real-time thoughts on different stocks and the markets in general. It's the best way to keep in touch with me outside of YouTube. And if you're ready to get started on your dividend investing journey, you can sign up using the links below for Robinhood, where you get one free stock just for signing up and connecting your bank account, or use the link below and sign up for WeBull, where you get 2 free stocks, one for signing up, one when you deposit $100, and one of those stocks could be valued up to $1,400. So check out the links down in the description if you're interested in any of that. And that's all for me. I hope you enjoyed the video, and I'll see you in the next one. Do that again, because I'm an idiot. No, not welcome back to today's video. Why do I always do that? Yeah, welcome back to today's video that's just starting. Oh, awesome. She was doing laundry and I thought for sure it was gonna buzz when I was in the middle of talking.